My name is Dave White. I oversee real estate debt strategies here in Europe for LaSalle. I joined the business about 2 years ago. We invest all throughout the capital structure, so we do senior lending through to whole loans, mezzanine, preferred equity, and we sit within a wider high-yield business that also picks up in terms of preferred equity, JV equity, and equity. LaSalle is obviously a global real estate investor. I won't bore you with that. I stepped back and, I sat down with our comms people about 3 months ago, and they said, we have this really exciting speaking opportunity for you. It's in Frankfurt. You're going to talk about debt structuring, and good news, it's at 9:30 after a very big dinner and several drinks at the hotel. So what could go wrong? So we'll jump into it. I kind of stepped back and thought about, I could sit here and try and come up with some entertaining slides. The ridgeline is obviously an overplayed or an exhausted theme. Or I could make this incredibly boring and see how that goes. And actually, I went with the boring road. So bear with me. But what I will talk about here is, let's talk about risk and return. Let's talk about structure, intercreditors, and benefits of whole loans. And so that's, that kind of encompasses the challenges of structuring debt. We'll keep it reasonably high level. But when we jump into risk and return, this has been a theme that we've covered quite a bit over the last 24 hours. And I think it's a really interesting topic when it comes to questions like, is now the right time to be in debt? Are you getting equity-like returns for debt? Talk about what we talked about yesterday in terms of debt being a put option. I think are all very valid points, but I think you need to put them into context and think about why are we making the returns that we're making and taking the risks that we're taking. So when we jump into the math, again, not interesting, but we'll talk you through it. You jump into the math. Let's talk about buying a building. So we're going to distill this way down. Very basic assumptions. Let's forget about purchasers' costs. Let's put inflation aside for a second. And let's just talk about if you buy a building unlevered, no debt, let's assume you buy it at a 5% yield. You buy it for 100, you're making $5 million a year. It's unlevered, there's no cash flow growth, and there's a 5-year hold. What does that mean from a risk and return perspective? So where we have on the bottom change in asset value. So if you lose 50% of your asset value over the term of 5 years, or you improve the value of your asset over the term of 5 years, what is your IRR? So as you can see, it's a reasonably linear line. Your break even, let's assume you don't create or deteriorate any value, you're going to make your 5%. If you lose 25% of your asset value, you're going to break even because you've been making $5 million a year for 5 years. Pretty simple math. But then let's talk